Hi, this is Brian Vendig, President and Chief Investment Officer here at MJP Wealth Advisors. Recording this video towards the end of July 2025, I wanted to check in with all of you. We're in the middle of earnings season, which was started this month, which is giving us a good sense of what the public companies are saying about the consumer, the economy, and their outlooks, while at the same point in time, we still have a lot of conflicting variables and headlines to pay attention to. So let's start a little bit with talking about where we're currently positioned, and then I'll lead into what our outlook is for the balance of the summer and the balance of 2025 as we start to look ahead over the course of this year. So right now, if we start with equities or stocks, we're pretty balanced between growth stocks and value stocks. And as a quick reminder, growth stocks, we're talking about mega cap tech names, things that are both in the technologies, communication, and consumer discretionary space, as well as value stocks, things that are in healthcare, utilities, industrials, financials. Value stocks are usually more tied to the economic growth of a company and of an economy, I should say, focusing on GDP growth. And we can say that over the last several years, technology stocks have been tied to the hopes of AI innovation and productivity gains for the economy as well as society. Now, when we think about what's been happening since April, we reached April lows. We had one of the quickest bounce backs in market history in about 65 trading days or so. And here we are with markets continuing to be at around all-time highs. So right now we are continuing to be sensitive to valuation of where some of these higher value growth names are playing. And we're starting to see underneath the hood of the market that there's been a broadening out. There's been a little bit more of a participation and rally coming from utilities, industrials, financials. And it's not just the mega cap tech story anymore. And I think that is a good news sign actually for a healthy market. Is seeing a little bit more of a snapback in those value names, catching up with leadership that we've seen over the last couple of years from the technology sector. And that's actually also how we have the equity part of your portfolio positioned. Because of valuations being a little bit higher right now in the markets based on historical precedent, we have a foot in that AI innovation camp, but we also have a foot in the value camp, and we're keeping those two at parity or on par. Now, part of the reason why we're doing that is we think that over the balance of this year into next year, you should see a little bit better performance coming from the value side of the house, especially when you think about deregulation, and we're seeing an increase in M&A activity. And as the Fed cuts interest rates over the next 12 to 18 months, that could spur more IPOs. Those are all good things for the financial sector. We're seeing in the industrial sector the need for infrastructure spending, reshoring of the supply chain, innovation that needs to happen in the utility space for a smarter energy grid, as well as more power generation that's needed for some of the innovation that's going on in our society, specifically AI, or just better efficiency in distributing electricity around the country. So these are all things that I would say are in that value camp that are some, I would say, thematic trends that probably aren't going to go away anytime soon. Plus, when you also think about infrastructure spending, we're talking about aerospace and other type of innovation. And also with the recent tax bill that was passed, companies can take some accelerated depreciation to offset the cost of investing in infrastructure and CapEx. And we're starting to see some of the signs of companies investing more in themselves. And I think these are all good news items for those value-oriented names. And one thing as well is for some of our more growthier thematic portfolio strategies, we have a bigger allocation to small cap stocks because considering that the economy doesn't look like it's going into a recession, and also the discussion around tax cuts, which will favor smaller companies in the future since they're more dependent upon borrowing. These are all themes that I think can also help small cap stocks continuing to bounce back from some of the tougher performance numbers that we saw in quarter one and parts of quarter two. So that's kind of our view of where things are right now and where our positioning is on the equity side. And on the bond side of the house, we are continuing to stay short duration in the portfolios, which means having bonds that mature in 4 years or less on average. And that's just because with the uncertainty around how price increases might flow through the economy due to tariffs, and also due to the fact that if economic growth exceeds expectation, interest rates might stay elevated, even though the Fed might be cutting interest rates later on in the year. They control the short end of the curve with their policy decisions, and the market controls longer interest rates in the marketplace. So as a result, we think interest rates have a chance of probably staying pretty range bound over the summer. But if economic growth continues to slow over time due to slower and lower consumer spending, being fickle due to price, or due to any sort of shocks that might come up in the global economy, then we expect rates to kind of stay around this range for a little while longer until we get a better view from the Fed based on policy decisions at the end of the year. So staying short on duration, balanced with high quality bonds that are single A rated or better, which is at the top of the capital stack. And also our fixed income has been yielding around 4% to 6% on average. I think that's very healthy and helps to support and balance out volatility that could come from equities. Now, as I mentioned, we're coming off of a period of time where markets are getting excited, got excited about a tax bill being passed and more certainty around fiscal spending and taxes. We're starting to hear more trade deals being announced. Most recently, a hint at a deal being done with Japan and a couple other in Asia that are in the U.S. back pocket that have been negotiated across the Asian continent. There's been seems like some good news items coming out of conversations with China, and that the August 12th deadline might be extended. And it seems like President Trump and President Xi might be meeting at some point over the next couple of months to finalize a trade deal. And then even this morning, we heard that negotiations are progressing with the EU. So I think these are things that have helped to propel the stock market higher over the last couple of months, because we've seen that the U.S. economy has not gone into recession. We haven't seen material impacts yet from tariffs. We see a healthy labor market still occurring. We saw a bounce back in consumer spending in June versus where we were in May. And we're starting to see that there might be a little bit more certainty to some of these uncertainties that we were worried about earlier in the year. So that's how we kind of got to this point. But I think when you take a look back at the bounce back that we had in the market from April to where we are right now in July, and we look at that move academically based on historical market moves in other periods of time where the market has bounced back quite quickly, it's our view that there's probably going to be some digestion over the course of the summer into the fall of some of these market gains. So I wouldn't be surprised if the market trades in a range, or if we even see a 3 to 5% pullback. And I don't necessarily see that as a bad thing. I think that's just a normal market cycle where sometimes markets get ahead of themselves, they come back. But if earnings outlooks as we get through the balance of earnings from July into August holds, and we get a little bit of help from the Fed later on in the year with interest rates, assuming that inflation is transitory when it comes to tariffs, as being a one-time tax that kind of works through the economy. And again, with a stable consumer, a stable labor market, that could help to provide the assurance that the market's looking for to grind higher by the balance of the year, and then start to look ahead at 2026, because numbers for 2026 are starting to look a little bit more robust than where we were earlier this year. So right now we're keeping an eye on trade deals. tracking earnings outlooks, and obviously staying abreast on how inflation might flow through the economy relative to finalization of tariffs. But if earnings are there, then we continue to expect positive performance both from stocks. And I think if the economy stays on stable footing, even if it slows a little bit due to consumer spending and that shift between investments in capital goods versus services, we should expect longer term inflation to actually come down, which means that longer term interest rates should also come down, which should be healthy for bonds as well. So we're kind of at this point right now where I think we're at an equilibrium in the market, but there could be some volatility and some digestion of things still to come over the summer into the fall as some of these variables work out. So we're not looking to add to risk right now. We're not looking to take away, and we're looking to continue to be very conservative with our bond allocations. So I hope all these updates help in the interim. But if you have any questions, please feel free to reach out to a member of our wealth advisory team. We're definitely happy to help. But again, as always, appreciate your ongoing trust and support, and a privilege to have a relationship with you, your family, and your business to be there to help. So thanks so much. I hope you continue to be well. Enjoy the balance of the summer, and we'll keep you updated as all these developments continue to play out over the weeks and months ahead. So thanks again, and appreciate your time. Take care. Bye-bye.